Hello everyone and welcome back to the podcast. Today we're going to be doing an update on my HelloFresh thesis. We're going to be diving deep into HelloFresh's Q2 2024 earnings report. This that you see on the screen now, which is actually my microphone, I figured out a way to reduce the echo, and that's by putting one of my driving gloves on top of it. So bear with me, I think that the audio is going to be a lot better, and let's get started because I really enjoyed writing this update. I think that HelloFresh is entering the Goldilocks zone. I think it's evolving into a highly asymmetric scenario potentially. So let's dive deep into it. In my original HelloFresh deep dive, I explained how the stock is moving towards a potentially highly asymmetric scenario. They have a tough challenge ahead, but if they get it right, they tap into an uncontested $1 trillion market. Simultaneously, the company remains pessimistically valued at just 0.21 times sales, despite the stock being up over 60% since I released my deep dive. Meanwhile, HelloFresh continues to exhibit notable process power, and in the Q2 earnings report, I saw HelloFresh making encouraging progress. Namely, HelloFresh is now increasingly pointing towards customers that value time over money. HelloFresh has an incredibly efficient and complex infrastructure that sends both meal kits and ready-to-eat meals to millions of people around the globe. But the unit economics don't work because the offerings are not quite cheap enough relative to buying food directly from the supermarket and cooking it yourself. In the deep dive, I explain how HelloFresh could potentially fix this by capitalizing on pockets of the market that are tight on time and have big wallets. In Q2, EBITDA, which stands for adjusted earnings before interest, taxes, depreciation, and amortization, came in at 7.5%, which is at the upper end of the guidance issued by management in Q1 2024. Allegedly, this is due to HelloFresh reassigning marketing dollars from lower quality customers to higher quality customers. This metric is actually down from 10% year over year, as you can see in the graph depicted on the screen now. So the data, as happened in the deep dive, remains blurry. But there's a catch. I see a sort of intra-quarter inflection point in the margins driven by this reallocation of the marketing budget. Before digging in, the source of this opacity is the meal kit business, as those of you that read my deep dive know, which grew very fast during the pandemic and is now right-sizing because people obviously don't have to eat at home all of the time. This is the biggest of the two divisions the company operates, and so the deleveraging is taking a toll on financials across the board. Meanwhile, the RTE, ready-to-eat business, is growing fast, and this requires considerable investment on behalf of HelloFresh, and it increases expenses, particularly on the procurement side, because RTE requires cooking the actual meals. Now, here's where it gets interesting. RTE has lower margins than meal kits, and the former's revenue has grown at 45% year over year. The fast growth of RTE is thus dilutive to margins, but meal kit margins have stabilized, coming in at 12.2% this quarter, slightly down from 12.9% year over year. Although the decline is not excellent news, the stabilization coincides with the change in the marketing philosophy. Additionally, HelloFresh has now lowered price incentives as it assigns a higher percentage of the marketing budget to the RTE business, which I think is populated by customers that value time more than money. And so the growth of that business is actually part of the change in the marketing philosophy. In turn, very importantly, RTE margins are up from minus 4.3% in Q2 2023 to 4% in Q2 2024. The change in the marketing philosophy was well summarized by co-founder and CEO Dominic Richter during the Q2 2024 earnings call. Here's what he said.
Overall, for both product categories, as flagged a few times now over the last few months and on this call, we recalibrated how we split our economic marketing budget between price incentives and paid channels, i.e., compared to last year, we started in Q1 to weigh more to the latter, i.e. to paid channels, with an overall beneficial impact on customer quality and retention.
In short, the key takeaway from this update and what I'd really like to see is that margins are up, of course adjusting for the downsizing of the meal kit business, as HelloFresh is now tentatively pointing towards customers of higher value. In the deep dive, I used the diagram that you can see depicted on the screen now to illustrate HelloFresh's unit economic issue. For most of its customers, it seems that HelloFresh is actually nice to have. But now I see the company on its way towards becoming an acute problem solver. The fastest growing component of the RTE business is the brand HelloFresh uses to operate in the United States called Factor. So qualitatively, I see Factor as being on the right side of the spectrum, and now they're really leaning onto it. So I like where HelloFresh is headed. Although HelloFresh has historically been on the nice to have side of things, the company has been printing cash from operations since the start of the pandemic, as depicted on the graph on the screen now. As I explained in the deep dive, this company operates one of the most complex supply chains on earth, or at least that I have seen. Moving perishables around with such precision requires a world-class ability to optimize processes. And this is why I say at the start of this write-up that the company continues to exhibit notable process power. The ability to print cash while not totally being on the right side of the spectrum is what truly caught my eye for this company. Indeed, now that the company is moving in the right direction, shifting towards the crucial pain-solving side of things can be highly accretive to the company's cash flow production. While the shift is yet to tangibly materialize, this quarter the company's cash from operations levels remain in line with previous quarters, as you can see in the graph below. What did increase notably this quarter was free cash flow production, as capex is trending down. As you can see in the graph on the screen now, free cash flow production is up 33.9% from H1 2023 to H1 2024. In the original deep dive, I highlight how for years HelloFresh's capex has been exceeding cash from operations by quite a margin, and that this situation reversed for the first time in the company's history last quarter, in Q1 2024. My major concern was that management would be cutting short the current capex cycle due to a not so ample net cash position and a rapidly declining meal kit division, and that this would ultimately hinder HelloFresh's ability to make it onto the right side of the aforementioned spectrum. But now that we're 2 quarters into the capex decline, I see some of the company's KPIs evolving healthily, and thus my concerns are somewhat mitigated. For example, average order value, AOV as HelloFresh refers to it, is up 5.6% year over year, as you can see on the screen now, as HelloFresh continues to make more items available at its HelloFresh market. Simultaneously, revenue is up 0.9% year over year, which, far from being delightful, does not quite imply a collapse of the company's earning power. Together with the expanding EBITDA margins, adjusting for the deleveraging of the meal kit business, as explained before, I see a healthy organization. During the Q2 earnings call, CEO and co-founder Dominik Richter explained that the AOV increase stems from a number of factors beyond just the aforementioned HelloFresh market component. Per this remark and the KPIs that I was outlining previously, I see a company that hasn't quite cut a capex cycle short, but rather I see a relatively healthy one, and even a fairly healthy one, dare I say. In conclusion, I like the direction HelloFresh is heading in. I see them shifting towards the right side of the spectrum, with the odds of them improving their unit economics going up in the last 2 quarters considerably. HelloFresh's process power has been evident to me since I analyzed the company, and should they become a crucial pain solver, which I think they are relatively close to doing so, at least for their Factor customers, I see considerable upside ahead, not only because the current valuation is excessively pessimistic, but because success on the unit economic front would imply HelloFresh evolving into a winner-takes-all player. HelloFresh, after all, doesn't have any actual competition, and the world is increasingly full of people that don't have time to cook. So I like this company. I'm not quite ready to pull the trigger yet. I don't really have to, because I think I have some tremendous picks in the portfolio. Palantir is up 5x, Spotify is up 4x, AMD I'm up 36x, Tesla 14x. HIMS I think is going to do very well going forward. So it's not like I'm in a rush to reallocate any of that capital. I think that those picks will perform very well for the coming decade. But this is evolving into a very interesting scenario for me, and it's one that I will continue tracking closely for the next few quarters. So thank you very much for joining me again. Again, can I please ask you one favor? If you enjoyed this, can you please share this with one friend? These deep dives are for free, and so the only way this grows is with your help. Thank you very much in advance. Remember that none of this is financial advice. Please do your own due diligence. All of my content is just for educational purposes only. And take care, and until next time.